Hey everybody, it's Jack and welcome back to another portfolio update video. It's been a little while since my last upload. I've been crazy busy with work and I'm also in the process of moving to a different city. So it's been a little hectic over the past month or so, but I'm back to making videos and I'm happy to share with you all how my WealthSimple challenge is going. For anyone who's new to the channel and wondering what it is I'm doing, I'm currently undergoing a WealthSimple Trade challenge where my goal is to bring an account from $1,000 up to $100,000 through saving like crazy and smart investing. So I deposit around $200 each and every week into this account in order to invest into the stock market. And really the long-term big picture end goal is to hopefully one day be able to retire, or at least help me retire, by using this investment account and the passive income that I gain. And we'll get into all of that and what I've been buying over the past month or so since my previous update video. Since my last portfolio update video, we've seen a lot going on in the stock market. In the middle of September to end of October, we saw the market sell off a little bit, dropping 4 to 5% from all-time highs. And then over the past month and a half, we've seen the stock market go crazy and continue to hit all-time highs once again. So there's been a lot going on in the stock market. So in this video, I'll be diving into all the stocks I've bought, some that I've sold, what is my strategy moving forward now that we are still trading at all-time highs, where am I finding value in the stock market. So let's now dive into all of that because there's lots to update you all on. So diving straight into how my portfolio is doing and how it's done over the past few months, it's currently sitting at $13,188.81. We're actually down over the past week as a lot of the Canadian dividend stocks sold off and came down a little bit from their all-time highs. So this past week, we were down $107.17 or 0.81%. So quite a little bit of a negative week. However, over the past month, we are currently up 3.42%. or $435.90. So quite a significant rally over the past month for stock market in general. We've seen a lot of new all-time highs and a lot of stocks across all sectors are doing quite well, which, hey, we won't complain about the stock market going up. However, it probably won't continue like this forever as it has been very generous over the past 6 months to a year. And that will definitely play a factor into what stocks I'm going to be picking up over the next little while and where I'm focusing my efforts and where you can find value in the stock market. So definitely wait for that later on in this video. Over the past 3 months, the account is up $598.97, so almost $600, and we're up 4.76% in those 3 months. And all time, the account is actually up $1,104.85. So we're up over $1,000 from when we started this journey back in February of 2021. And that doesn't even include the dividends that we've actually collected over the past few months. And that passive income snowball is really starting to grow. And in percentage wise, the account is up 9.14%. So I'm really happy with the account so far over the past 8 months. And really over the past 2 months since my last update video, there's been a lot going on. So let's now dive into my spreadsheet where I can show you all of my positions as well as the passive income and how it's been growing. All right, so before we dive into all of my charts and the breakdowns of all of my positions, as well as my passive income and the annual dividends that I get, let's first go through what I've been buying and what I've been selling over the past few weeks. So starting it all off at the top with Algonquin Power and Utilities, Algonquin, AQN, has not been doing very well over the past month or two. At one point hitting its 52-week low, which is always not a great thing. However, I've been continuously dollar cost averaging into Algonquin Power and continuously picking up shares. I think I've been picking up around 2 or 3 each and every week, lowering down my cost and getting in at a better price because it is currently sitting at a 4.73% dividend yield. So almost 5% dividend yield at the current price, which I think is great for Algonquin Power. And this is a stock, a utility stock, that I think is just going to do really well over the next 5 to 10 years. They have 33% of their business, so a third of their business in renewable energy and assets. So this is really going to help drive it for growth moving forward over the next decade as we do move towards more renewable options and more sustainable utilities. So for this reason, I've continuously been buying Algonquin Power below $18. I think if you can get Algonquin below $18, it's a great deal moving forward. So I'm currently down 8% on this position, or down around $90, and it currently makes up 7.4% of my portfolio. So it is one of my larger positions, and I have no problem adding to it at this price. The next stock that I've been adding to is Fortis, ticker symbol FTS. This is a great utility stock, just like Algonquin Power. This is one that's raised its dividends for, I believe, 48 years straight. It has a 48-year dividend growth streak, which is one of the top growth streaks in Canada, just behind Canadian utilities. It currently has a dividend yield at 3.8%. It makes up 5.8% of my portfolio. so not as big as Algonquin Power. This is just a super stable and reliable stock. This is a great buy and hold for the entirety of your life. You can hold this one for years and years and years and just really take advantage of that dividend growth each and every year. The next stock I've been adding to is Manulife Financial, ticker symbol MFC. This is another great dividend growth stock that has had a lot of news come out over the past month. Just a week or two ago, it announced that it'll be raising its dividend by 5 cents per share, which is actually an 18% dividend increase, which is quite substantial, which now gives Manulife an over 5% dividend yield. So this is one that you get a really hefty dividend from, and it's also a stock that I think is currently undervalued. They missed a few earnings reports, but they've also just landed a huge contract for the next decade or so, and one that is trading at a very fair price compared to some of the other stocks, especially Canadian dividend stocks that are trading near all-time highs. So Manulife is definitely one that I'll continue to add to, as it currently makes up 5.8% of my portfolio, and I am currently down around 1.2% on this position. So definitely continue to dollar cost average and bring my cost down while also getting that over 5% dividend yield. Seems like a no-brainer. The next stock that I've been picking up over the past few weeks is Enbridge, ticker symbol ENB. This is an oil and gas stock that has also been trading down a bit from its all-time highs. It's currently trading around $50 per share. It was trading upwards of around 53, almost $54 per share at one point. So it has dropped around 7% since then. So I think this is a great price to buy it at, around $50 per share. My current average price is around $47. So I will be kind of bringing my dollar cost average up a bit, which is okay. I'm currently up 5% on the position. It currently makes up 5.2% of my portfolio, and it has a relatively high dividend yield, which is awesome for passive income, sitting at 6.6%, which is one of the main reasons I love Enbridge. It brings up that average portfolio yield within my portfolio and a really great dividend to hold for the next few years. So not only a great dividend, but again, it's trading at a current price that I think is very favorable, around $50 per share. A lot of the price targets on this stock are above $55, which would be a 10% increase from the current price. So not only are you getting a great dividend, but you're also getting that share price appreciation, hopefully. The next dividend stock is a no-brainer, one that you've definitely heard on the channel, Smart Centers Real Estate Investment Trust, ticker symbol SRU.UN. This is a monthly dividend payer that pays around a 6% dividend yield, just under currently. And this is one that's been doing really well over the past few months. It's consistently continued to go up in share price while paying a great monthly dividend. This is one that I've just added to here and there every few weeks, just picking up a share or two and really just building that monthly passive income as I continue to grow out my portfolio and my position in Smart Centers, as it currently makes up around 5% of my portfolio, sitting at 5.2%. The next dividend stock on my list is Brookfield Renewables, BEPC is the ticker symbol. This is a renewable energy company and one that I'm down on currently. I'm currently down around 5.5% on Brookfield Renewables. This is one that, again, looking at a horizon of 10 to 20 years, I think renewable energy is a no-brainer. And this is one that pays around a 3% dividend. So it's a dividend stock that hopefully will also see a lot of share price growth as we move towards more renewable options. And it currently makes up 5.8% of my portfolio. And as I'm currently down on this one, it's definitely one that I will continue to pick up over the coming weeks, as I think it's a great long-term hold. So the next major stock that is a new one in my portfolio is ticker symbol AEM, Agnico Eagle's Mine. This is a gold miner. And if you've been following the channel, you know that I used to have Kirkland Lake Gold, another Canadian gold miner. However, it came out around 2 to 3 weeks ago that they're actually merging, or that Agnico Eagle is actually acquiring Kirkland Lake Gold. And what this means for a shareholder of Kirkland Lake Gold is that for every share of Kirkland Lake Gold that you own, it's going to transfer over to 0.7935 of an Agnico Eagle or AEM share at the time of acquisition. So it's still waiting to finalize. So when this was announced, I actually sold my Kirkland Lake Gold almost on the spot, as at the time I did the math and there was actually a price discrepancy between the two shares. So if you actually did the math and you did price of Agnico Eagle times 0.7935, it was actually trading at much of a discount compared to the actual transfer of shares. So basically, by selling my shares and buying Agnico Eagle and at the time, instead of waiting for them to automatically transfer when the acquisition goes through, I actually was able to save a bit of money. So this is definitely something I recommend when you see that an acquisition is going through. First, do your research on the company that's acquiring, because Kirkland Lake Gold was, for many reasons, for one of the companies I owned. It had a great dividend growth track record. It had increased its dividend like crazy over the past few years. And it also was just had a really good management team. So this definitely changes when they go over to Agnico Eagle. And for this reason, I'm not as big a fan as Agnico Eagle as I was Kirkland Lake Gold. So I did kind of trim my position a bit. I had around 4.5% of my portfolio in Kirkland Lake Gold. If you look at AEM right now, I currently have around 3% of my portfolio. At the time of selling my Kirkland Lake Gold, I sold it for around a 14% profit, I believe. And you can now see that I'm still up around 5.7% on Agnico Eagle from when I purchased it. So in a pretty short time frame, I'm already up 6% on this new position, which I'm happy about. And it actually has a larger dividend yield than Kirkland Lake Gold did. Kirkland Lake Gold had a dividend of around 1.8%. Agnico Eagle now has a dividend around 2.5%. So it's definitely nice to get a little bit more passive income from this position. I still want to have a gold miner in my portfolio as a type of hedge against inflation. So now that we're done with my dividend stocks, if we go into my growth stocks, again, they're still not doing very well in terms of my overall portfolio. You can see that 4 out of my 5 kind of penny stocks or higher growth, higher risk stocks are down around 15% for 3 of them. These were down even more, so they have bounced back a little bit. They were down around 25 to 30% for most of them at one point. They have bounced back a little bit, but they're still not doing too well compared to the rest of the market. This is an area that I do see value in currently, so I will be adding to these positions. I have been adding to my Greenlay renewables the most over the last little while. I had around 250 shares, I think, in my last update video. I now have around 310, so I've added around 60 shares to this position. I brought my average cost down a lot. It was at $1.80. It's now at $1.67. Below the $1.50 range is where I think Greenlane Renewables is a very attractive evaluation. I think this is a $3 stock over the next year or two. So picking it up at $1.50 means 100% gain if it's able to get to that $3 range over the next year to 2 years, which I think is amazing. And this is one, again, that's in the renewable space. I've also been dollar cost averaging into some of my other penny stock or higher growth stocks, such as Good Natured Products. I recently picked up around 30 shares of GDNP at around 88 cents, I believe. It's currently at 89 cents, so hasn't changed a lot since I bought it, but I did dollar cost average as my average cost was sitting at around $1.20. So I was able to bring down my average cost quite a bit. It's now at $1.11. Again, I'm still down a lot on this position, but it's a smaller weighting in my portfolio. I've also been dollar cost averaging into Data Communications Management Corp, one that I'm currently down around 6%. At one point, we were down 15 to 20% on this position. It's had a nice little bounce back over the past few weeks. At one point, we were actually up in this position around 5%. And since then, it's dropped a little bit back down to the $1.10 range. It currently makes up around 2.5% of my portfolio, so I'll probably leave it at this. I probably won't add to it a whole lot more in the near future. Later on I might, but I'm definitely just going to see how the momentum starts to build, if the stock is going to start to go back in the upwards direction, or if it's going to drop back down to that dollar range where it was hovering for a while. So this is kind of one that I'm just waiting on and letting it see how it plays out. The next major stocks, or ETFs I should say, that I've been adding to are my NASDAQ 100 ETF and my S&P 500 ETF. These are my two major US ETFs that again give you great exposure to big tech and some of the largest companies in the US. As a Canadian, I highly recommend getting some exposure to US stocks as they have a track record of really great long-term growth. So you can really backbone your portfolio with these great growth stocks such as your Apples, Amazon, Google, Microsoft, you name it. These big tech companies that have just grown like crazy over the past few years. These are just really great foundational stocks for any portfolio really. Currently in my NASDAQ 100 ETF, I have 8 shares and it makes up 8% of my portfolio. This actually is the largest position now in my portfolio, which I'm happy about. And my S&P 500 makes up just below it at 7.8%. So I've really been boosting these up over the past few months. They are at all-time highs, so I'm kind of pulling back a bit on how much I'm adding to them. But in the big picture, I would love these to be at 10 to 15% each in weighting of my portfolio. So if we now take a look at my passive income and my dividend tracking to see how my annual dividends have been growing as I purchase more and more stocks and more of my shares, we can now see that my current annual dividends sits at just shy of $400 at $399.14. For my previous update, it was at $314, so quite a substantial growth in the annual dividends over the past 6 to 7 weeks since my last video. And this is really the whole point of dividend investing. You just continuously grow the annual dividends as you buy more shares. And again, those shares pay you dividends, which then you can buy even more shares with. And that snowball really starts to grow. So the monthly average is now sitting at $33.26, and the overall portfolio yield is sitting just over 3% at 3.07%. If we now jump into my actual portfolio breakdown, where you can see how much weighting each one of my stock position has against the others, you can see that, like I mentioned, my largest positions are my 2 US ETFs, my NASDAQ 100, QQC.F at 8%, and VFV at 7.8%. And then some of my major dividend stocks such as AQN, TD, and TELUS all make up around 7.4% of the portfolio each. And then it starts to slowly go down from there, with the majority of my dividend stocks sitting around 5 to 7%. And then the growth stocks a little bit lower than that, kind of between the 2 to 4% range, as they're a little bit riskier. So I kind of bring them down in weighting, which is what I would recommend for anyone. Have less exposure to the riskier plays. This way you can get diversification in small caps and large caps, but mitigating your risk. And if we actually go into the sector allocation, where you can see the breakdown of each sector in my portfolio and how much it takes up in weighting, you can see that the largest sectors in my portfolio are my ETFs, as well as utilities, financials, and renewables. Those are kind of just great dividend stocks in utilities and financials. The big banks in Canada are some of the best dividend stocks. I can't stress that enough, as well as utilities such as Fortis and Algonquin Power. Just really steady and reliable dividend growth stocks that if you hold long term will really benefit from that snowball and seeing those dividends grow each and every year. And if we hop over to my asset allocation, where we see the breakdown between ETFs, growth stocks, and dividend stocks, you can see that dividend stocks are far and wide the larger part of my portfolio at 63%. And then ETFs makes up around a quarter at 26%. And then growth stocks are the smallest sliver at 10%. As I mentioned, I do want to get up my exposure in my US ETFs a bit more so that they're each around 10 to 15%. And that hopefully my ETF position of my portfolio will actually be around 30 to 35%. That's where I'm aiming to have it in the long term. I'm happy with 10% in my growth stocks, as again, they were a much larger position to start off, and then they haven't been performing very well. So I've kind of cut back on how much I've been adding to them. As we start to see them pick back up, and if they do start to perform better, I'll definitely start to chip in more into these stocks, as I have chipped in a fair amount as they've been down dollar cost averaging. But again, they haven't really been doing too well, so I haven't been going crazy on growth stocks. However, I am starting to think that there is going to be opportunities in these stocks, as all other stocks are trading at all-time highs. The majority of large cap stocks are at those all-time highs, so they're not as an attractive investment. So it might be time to start looking at the small caps again and starting to add a little bit more to them. If we now look at my weekly watch list, this is kind of reflected in the stocks that I'm looking to pick up. Again, Greenlane Renewables below $1.50 is one that I think is a no-brainer over the next year or two. I think this is a $3 to $4 stock, and Greenlane Renewables is currently trading at around $1.40, so I'm planning to pick up 25 more shares. Nothing crazy, but just continuously adding to this one at the prices that it's seeing. I also have my S&P 500 ETF in here, VFV. This is one that, again, grows 8 to 10% on an annual basis and is really just a steady grower. It is trading at all-time highs or at close to all-time highs, so I am a little skeptical. I'm kind of waiting for a small pullback in the S&P 500 before I buy another share, as I do want to get it up to around 10% of my portfolio. In terms of dividend stocks that I want to add to, mostly I'm focusing on stocks that I think have either just raised their dividend or will be raising their dividends over the coming weeks. So the first one is Manulife Financial, ticker symbol MFC. They just announced that they're going to be raising their dividend for the next payout by 18%, which is awesome and brings up their dividend yield to above 5%. So a really nice dividend from Manulife Financial. Not only that, but they also announced at the same time as their dividend increase that they're going to be planning to buy back shares. The announcement said that they plan to buy up to 39 million shares back from the general public, which is around 2% of all outstanding shares. This is really promising. As a company, when they buy back shares, it adds value to all of the other outstanding shares because they're taking them off the market. So your share makes up more of the company, and it really just adds value to you as a shareholder. So this is great to see for anyone who's holding MFC. And then I also have my Canadian Dividend ETF on my watch list, VDY. This is a monthly dividend payer that holds 50% of its holdings in the big Canadian banks. The regulation that they were all under to not raise their dividends or not buy back shares was lifted, and that's why Manulife raised their dividend and announced share buybacks. And I really think the Canadian big banks are all about to raise their dividends by at least 10%, ideally almost closer to 20% like Manulife Financial. I don't think that's going to be unheard of. So by buying VDY, I'm going to be able to take advantage of all of those dividend increases across all of the big banks, and hopefully that will increase the monthly payout of VDY each and every month. I do hold TD directly in my account, but VDY is how I get exposure to the other Canadian banks, as well as some other great dividend stocks out there. So to recap, over the past month and a half to 2 months, the major kind of moves or takeaways for my portfolio is first, that I've been trying to get my US exposure in my account really boosted up by adding to my NASDAQ 100 as well as my S&P 500 ETFs, trying to get those between 10 to 15% of my portfolio so that around 20 to 30% of my overall portfolio will actually be in the US stock market exposure. so that I can hopefully get the growth of the US and those big tech companies. And then secondly, I've also just been adding to my core dividend stock positions, my really great dividend growth stocks. As we've seen with Manulife, it just recently raised its dividend by 18% as the regulations around a lot of the financial Canadian stocks actually got lifted over the past few weeks. Hopefully the big Canadian banks will also follow. And then the third area that I'm kind of investing into slowly is also still my growth stocks. I'm some more speculative plays. I'm really bullish on Greenlane Renewables moving forward, and I'm going to continue to add to these positions as I do see a lot of value in small caps in today's markets. As the value stocks and dividend stocks are at all-time highs, small caps still got hurt really bad over the past 6 months and are still recovering. Well, I hope you guys enjoyed this recap. I'm back to making videos, hopefully more regularly, and I know this was a long time since my last upload. However, I am going to be moving soon to a new location and a new apartment that hopefully will give me the ability to start making more regular videos on a more consistent basis for you all. That's the goal. And if you guys enjoyed this video, make sure to smash that like button and subscribe to the channel if you aren't already. Lots more videos coming your way over the next little while. I'll see ya in the next one.